1 month, just 30 days, and silver dropped from $90 all the way down to $65. That's not a dip, that's a warning. But here's what nobody is telling you. The analysts who predicted this crash, the insiders who worked inside Goldman Sachs and JP Morgan, and a mining CEO who just revealed numbers, that should make every serious investor stop everything they're doing. They're all saying the exact same thing, and it has nothing to do with silver being broken. It has everything to do with what's coming next. Because when the world's safest assets start falling together, it doesn't mean the game is over. It means the game is just about to change. Welcome to Currency Insight, where we don't chase headlines. We read between them. Now, before we go any further, if you've been with us for a while, naotai, and you know who you are, do me a small favor. You know how your doctor always says, don't skip your checkup? Well, think of that subscribe button the same way. Just a small click that keeps you informed, protected, and ahead of everyone else. Hit it. It takes less effort than opening your morning newspaper. And while you're at it, drop a comment below. Where in the world are you watching us from today? Are you in the United States, Europe, the Middle East, Asia? Because this story we're about to tell you affects every single one of those places. All right, let's get into it. Something strange happened in the silver market, and most people missed it completely. In the span of just 30 days, the silver price fell from $90 per ounce all the way down to $65. Nearly $25 wiped out in 1 month. For the average investor watching their portfolio shrink, it felt like the floor had disappeared. It felt like everything that they had been told about silver, about it being a safe haven, about it being the ultimate store of value, had suddenly turned out to be wrong. But here is the thing, it wasn't wrong. What happened to silver in those 30 days had almost nothing to do with silver itself, and the investors who understood that distinction are the ones who didn't panic, the ones who didn't sell, the ones who are now quietly positioning themselves for what comes next. So, what actually happened? When markets get nervous, investors run towards safety. That has always been the rule. Stocks fall, gold rises, uncertainty grows, silver strengthens. That is how it has worked for decades. That is what every textbook, every analyst, every financial advisor has always said. But something different happened this time. Gold fell, silver fell, crypto fell, all at the same time, all together, with no major crisis headline, no central bank shock, no geopolitical explosion that the news was covering. To most people watching, this made no sense. If everything is falling, including the so-called safe havens, then where exactly is the money going? The answer is simple. And once someone understands it, everything else starts to make sense. The money was going to cash, not to gold, not to bonds, not to any asset class, just cash. Plain, liquid, sitting in an account cash. This is called a flight to cash, and it is very different from a flight to safety. When investors are forced to raise money quickly, they do not sell what they want to sell. They sell what they can sell. They sell the assets that move the fastest, the ones that trade instantly, around the clock, anywhere in the world. Gold, silver, crypto, these were not falling because they were weak. They were falling because they were useful, because someone, somewhere, needed the money more than they needed the hedge. To understand where all that cash was going, one needs to look at what was happening in the broader market at exactly the same time. Some of the largest initial public offerings in financial history were hitting the market simultaneously, companies raising hundreds of billions of dollars, OpenAI, Anthropic, others lined up behind them. Meanwhile, Google shifted from buying back $60 billion of its own stock to issuing $80 billion in new shares, pulling that cash directly out of the financial system. Private credit markets were seeing redemptions, margin debt. Money that investors had borrowed to make investments was sitting at an all-time high relative to the size of the entire economy. All of these forces were demanding the same thing at the same moment: cash. Trillions of dollars worth of demand for liquidity, all hitting at once. And when that happens, everything gets sold. Not because it is bad, but because it is available. Silver was available, gold was available, and so they were sold This is what analysts call a liquidity-driven downturn. It is not panic in the traditional sense. There is no screaming on trading floors. There is no single catastrophic headline. It is quieter than that. It is everyone, slowly and professionally, reaching for the same exit at the same time. Here is what serious investors and business-minded individuals need to understand about this moment. The price of silver did not fall because the world suddenly needed less silver. It did not fall because the fundamentals changed. It did not fall because the long-term story was broken. It fell because of plumbing, financial plumbing, the mechanical, behind-the-scenes movement of money through a system that was temporarily overwhelmed by demand. And when plumbing issues get resolved, and they always do, the water starts flowing again. The question is never whether the pressure will return. The question is whether someone was positioned correctly when it did. Because the investors who understand the difference between a broken market and a stressed one are not watching the silver price with fear right now. They are watching it with something else entirely: patience. There is a number that almost nobody in mainstream finance is talking about. 0. Not a percentage, not a ratio, not a price target, just 0. It is the current reading on something called the bullish percentage index for gold mining stocks, a measurement that tracks how many companies in the gold and silver mining sector are showing any positive technical signal at all. And right now, that number has hit the floor. Completely. Totally. 0. In the entire recorded history of this index, this has happened exactly once before. December 2015. And what happened immediately after December 2015 is something that every serious investor, every aspiring entrepreneur, and every business-minded individual in this audience needs to understand deeply. Because history in the precious metals market does not just rhyme. Sometimes it repeats almost exactly. Before getting to 2015, there's an older story that deserves attention first. Because the situation unfolding in the silver and gold market right now carries a striking resemblance to something that happened in the years leading up to the 2008 financial crisis. At that time, a specific type of financial insurance existed. It was called credit protection on subprime mortgage bonds. Essentially, it was a product that paid out if the mortgage market collapsed. And between 2005 and 2007, the price of that insurance was falling, dropping, getting cheaper, even as the risks behind those mortgages were quietly getting worse. Most investors looked at the falling price of that insurance and concluded one thing: nothing to worry about. But a small group of people looked at the same falling price and concluded something completely different. This is the opportunity of a lifetime. They held their position. They endured months of losses on paper. They were questioned, mocked, and second-guessed. And then 2008 arrived, and they were proven spectacularly correct. A movie was eventually made about them. Now consider what silver and gold represent in today's economy. They are the world's oldest monetary insurance policy, the asset that has preserved wealth through every financial crisis, every currency collapse, every empire that overextended itself. And right now, just like that mortgage insurance in 2006, the price of that protection is falling. The question serious investors are asking themselves is not whether they recognize this pattern. The question is whether they have the conviction to act on it. It would be easy to dismiss this analysis as optimism, as the kind of thinking that precious metals investors always engage in, regardless of the evidence. But the voices speaking right now are not cheerleaders. Todd Bubba Horowitz, a legend in the precious metals trading world, looked directly at the simultaneous sell-off in gold, silver, and high-growth stocks and called it immediately for what it was: a margin call, a system-wide forced liquidation event. His conclusion was not complicated. Once the fear settles, once the margin calls have been satisfied, the money flows back. It always has. It always will. Peter Spina, one of the most respected analysts in the sector, added important technical context. Gold and silver, in his view, overshot dramatically to the upside earlier in the year, and now they are overshooting just as dramatically to the downside. Markets move in extremes. That is their nature. And when an extreme to the downside follows an extreme to the upside, what follows next has historically been a powerful, sustained recovery. Then there is the voice that perhaps carries the most weight in this conversation. A man named North Star Bad Charts, an analyst who had been publicly bearish on silver, who called the correction before it happened, who warned his audience that a large pullback was coming and that it could get uncomfortable. He was right, completely and precisely right. And now, that same analyst, the biggest bear in the room, is saying something that should stop every serious investor in their tracks. His exact message, delivered publicly, was this: "We have barely begun this bull era." To understand why that statement carries such weight, one needs to look at a chart pattern that technical analysts consider among the most reliable in all of financial markets. It is called the cup and handle. The silver price began forming this pattern in 1980. The cup took decades to complete. The handle formed. And the breakout, the moment when the price finally cleared the rim of that massive multi-decade formation, has already occurred. What makes this pattern particularly significant is a rule that experienced technical analysts consistently apply to it. The longer the cup takes to form, the more powerful the move that follows the breakout. This cup took 45 years. 45 years of compression. 45 years of energy building beneath the surface. And the analysts studying this pattern are not talking about modest price increases. They are talking about silver prices that the average investor today would find almost impossible to believe. There is one final concept from this chapter of the story that demands attention. It is called asymmetric opportunity. It means that the potential reward in a given investment is significantly larger than the potential remaining risk. Not equal, not balanced, genuinely mathematically lopsided in favor of the investor. Here is what that looks like in practical terms right now. From current levels, silver could theoretically fall another $15. That is the downside scenario that even the most cautious analysts are discussing. But those same analysts are discussing upside targets of $50, $100. Some going significantly beyond that. That is not speculation. That is arithmetic. And for the business community, for the entrepreneurs, for the serious wealth builders in this audience, asymmetric opportunities of this scale do not appear frequently. When they do appear, the investors who recognize them early are rarely the ones who regret it. But before anyone can fully understand the scale of what is coming, there's something else that needs to be examined first. Something that most investors have never been told about the silver and gold markets they think they already understand. Something that a former Goldman Sachs and JP Morgan insider recently revealed publicly. And it changes the entire picture. Imagine walking into a bank, depositing $100, and then discovering years later that the bank had taken that $100 and quietly told 7 different people that it belonged to each of them, individually, simultaneously, without any of them knowing. Most people would call that fraud. In the gold and silver market, they call it standard practice. And the woman who spent decades building these exact instruments inside the most powerful financial institutions on the planet has finally decided to talk about it openly. What she revealed is not a conspiracy theory. It is not speculation from the edges of the internet. It is a precise, professional, first-hand account of how the paper, gold, and silver market actually functions. And once someone truly understands it, the way they look at precious metals, at financial markets, and at the entire global monetary system changes permanently. Her name is Tanya Zimmerman. She spent decades structuring financial derivatives at Goldman Sachs, JP Morgan, and Credit Suisse. These are not small institutions. These are the organizations that effectively set the price of gold and silver for the entire world. She was not an observer of this system. She was an architect of it. And here is what she says about gold accounts held at major banks. They are not fully backed by physical metal, not even close. The reserve ratio, meaning the amount of actual physical gold sitting in a vault relative to the amount of gold that has been promised to customers, sits somewhere between 10 and 20%. Let that settle for a moment. For approximately every 7 ounces of gold that an investor believes they own through a bank account or paper instrument, only 1 ounce actually exists in physical form somewhere in a vault. The other 6 are promises, digital entries on a ledger, numbers on a screen, and in the futures market, where the majority of daily silver and gold price discovery actually occurs, the situation is even more extreme. Futures positions require only a small margin deposit. The leverage involved means that paper silver and gold trade in volumes that are many, many times larger than the total amount of metal that is actually mined in an entire year. This is the mechanism that controls the price, not supply and demand in the traditional sense, not the physical market, paper, promises, and the collective agreement of participants not to ask too many uncomfortable questions. Here is the critical detail that every serious investor needs to understand about this structure. It works perfectly as long as nobody asks for their metal. The entire system, the pricing mechanism, the fractional reserve structure, the paper promises, function smoothly when investors are content to hold digital representations of silver and gold rather than the physical metal itself. When confidence is high and nobody is rushing for the exits, the illusion holds. But confidence is not permanent, and the cracks are already showing. What is happening right now in China and India tells a very different story from what the paper markets are projecting. Both nations are accumulating physical metal at a pace that is accelerating, not slowing. The Shanghai Gold Exchange and the Shanghai Futures Exchange are seeing more and more physical metal flowing into their vaults. These are not paper transactions. These are not digital promises. This is real, physical, tangible metal being moved, stored, and held. China and India are not playing the paper game. They are quietly, systematically, and deliberately pulling real metal out of a system that does not have nearly enough of it to satisfy everyone who believes they own some. For decades, the major financial institutions maintain near complete control over the price of gold and silver through the paper market. When prices rose too fast, paper supply could be created almost instantly, suppressing the move. When sentiment shifted, the leverage embedded in the futures market amplified the downward pressure. It was an elegant system of control, but elegant systems have a weakness. They depend on the participants believing in them, and belief, once it begins to erode, rarely reverses. The first visible crack appeared in December and January of this past year. Physical demand began overwhelming the paper pricing mechanism in ways that the institutions struggled to manage cleanly. The premium between paper price and physical price, the gap between what the futures market said silver was worth and what someone actually had to pay to hold it in their hand, began widening in ways that veteran traders described as unusual. That gap is a signal. It is the market quietly communicating that the paper promises and the physical reality are drifting apart. And when that drift becomes wide enough, when enough investors in enough countries decide simultaneously that they would rather hold the real thing than trust a number on a screen, the pricing system that has controlled silver and gold for generations faces something it has never successfully managed before: a global demand for delivery. Here is the practical conclusion that the business community needs to take from this chapter of the story. The price of silver that appears on a screen today is not a pure reflection of physical supply and physical demand. It is a reflection of a paper market that has multiplied the apparent supply of silver by a factor that bears no relationship to the metal that actually exists, which means one thing with significant clarity: when the paper market loses its grip, and the evidence suggests that process has already quietly begun, the price discovery that follows will not be gradual. It will be sharp, it will be fast, and it will reflect, perhaps for the first time in a generation, what silver is actually worth when measured against genuine scarcity. And speaking of genuine scarcity, there is a set of numbers that a silver mining CEO recently revealed publicly at an industry conference. Numbers that were not covered by mainstream financial media. Numbers that complete this story in a way that is both sobering and, for those positioned correctly, extraordinary. When the data stops being theoretical, when it stops being about charts, ratios, paper markets, and analyst opinions and becomes something far more concrete, far more urgent. That moment arrived quietly at an industry conference in Vancouver when the CEO of a silver mining company stood in front of a room full of resource professionals and delivered three numbers: 52, 46, 38. Those three numbers, spoken calmly and without dramatic emphasis, represent something that the mainstream financial media has not yet fully processed. Something that changes the fundamental conversation around silver from a monetary argument into a pure supply reality. In 2025, there were 52 dedicated silver mines operating worldwide, not exploration projects, not development stage assets, actual producing silver mines actively pulling metal from the ground. This year, that number has dropped to 46, and by 2027, based on already announced closures and projections that mining executives themselves consider reliable, that number is expected to fall further still, to 38, from 52 to 38, in just 3 years. That is a reduction of 14 dedicated silver mines. 14 operations that were producing metal, employing workers, supplying the market, simply ceasing to exist as contributors to global silver supply. The mathematics are not complicated. That represents a decline of approximately 25% in the number of dedicated silver mining operations on the entire planet, within a 3-year window. During a period when global demand for silver is not decreasing, it is accelerating. To fully appreciate why this supply contraction matters so deeply, one critical fact about silver production needs to be understood. 70% of the world's silver does not come from silver mines. It comes by accident. Silver is a byproduct, a secondary output of copper mining, zinc mining, lead mining, and other base metal operations that are primarily focused on extracting something else entirely. These operations do not respond to silver price signals. They do not increase silver production when the silver price rises. They produce silver incidentally as a consequence of pursuing other metals, which means the world's silver supply is largely outside the control of silver market dynamics entirely. The 30% that comes from dedicated silver mines, the operations being counted and watched by industry insiders, is the only portion of supply that can realistically respond to demand signals, and that portion is shrinking. Visibly, measurably, on a timeline that has already been announced. While the supply side of this equation is contracting, the demand side is moving in the opposite direction entirely. Silver is no longer simply a monetary metal or an investment asset. It is a critical industrial material embedded in technologies that the modern world has decided are non-negotiable. Solar panels, electric vehicles, semiconductors, medical equipment, defense systems. Every major technological trend driving the global economy forward requires silver, not as an optional component, as a fundamental material with no viable large-scale substitute. The world is consuming more silver every single year than the mining sector is capable of producing. That deficit is not a projection. It is not a forecast. It is the current reality, documented, measured, and acknowledged by the industry professionals closest to it. And now, on top of that existing deficit, the number of mines actively producing silver is declining by 25% over 3 years. What serious investors do with this information? The story that is unfolded across these 4 parts is not a story about silver having a good year. It is a story about a fundamental, structural misalignment between what the world needs and what the world is capable of producing. The liquidity crisis that drove prices down was temporary. Liquidity crises always resolve. The historical signals pointing toward a major reversal, the zero reading on the bullish percentage index, the cup and handle pattern 45 years in the making, the margin call mechanics that veteran traders have seen resolve before, these are not permanent conditions. The paper market that has suppressed true price discovery for decades is showing its first real signs of losing control. That process, once started, does not reverse, and the physical supply of silver, already insufficient to meet current demand, is about to get meaningfully smaller. For the business community, for the entrepreneurs, for the serious wealth builders who have followed this analysis from the beginning. The question was never whether silver's moment was coming. The question was always whether they would be positioned before it arrived. That window is still open, but windows like this have a habit of closing far sooner than anyone expects.